Okay, everybody. Good morning. Welcome to the second day of the big conference. And we'll be starting now. So if everyone wants to come sit down and join us, who's in the back there, that'd be great. Hello to everyone who's online as well. Thanks for joining us today. This session is the Distributional Impacts of Universal Basic Income Policies panel. My name is Scott Santons. I'm a member of the planning committee for this year's conference. I'm also the author of the book Let There Be Money, which is available free over here. Everyone can grab a copy whenever you like. And I'd like to thank our sponsors for today too, and this whole conference. Our sponsors are the Gerald Huff Fund for Humanity and the Humanity Forward Foundation and Steady and Aid Kit. So thank you all for your generous support of the conference. Before we begin, please be aware that the session is being recorded and will be available to view on Crowdcast after the conference. Please visit the conference website for more information. Our speakers joining us today are Nikhil Woodruff and Aleida Baumgartner. And we're also being joined remotely by Almaz Zelleke. And just to let you know a little bit in advance, a little intro to the speakers too. Nikhil is the UK Research Director of the UBI Center, a think tank analyzing universal basic income policies, and co-founder and CTO of PolicyEngine, a nonprofit enabling anyone to compute the impact of public policy. Aleida Baumgartner is an MA student in economics at New York University. Their research interests include labor economics, poverty, and economic inequality. Aleida earned a BS in economics from George Mason University. Almaz Zelleke is a PhD of Harvard University, is professor of practice and political science at NYU Shanghai, where she teaches political science and comparative political economy, and was until recently the director, the undergraduate social science major. Her academic interests are in political theory and public policy, feminist political theory, and comparative political economy. Her articles of basic income, distributive justice, welfare policy, and feminist political theory have been published in Basic Income Studies, Political Quarterly, Journal of Sociology and Social Welfare, Policy and Economics, Review of Social Economy, and Journal of Socioeconomics. For more information, visit almazzelleke.com. Right, so we're going to format this. We'll do 55 minutes for all three of us here, and we'll go ahead and follow it up with 15 minutes of Q&A. And yeah, let's go ahead and start with Nikhil.
Thanks, Scott. Yeah, so just waiting for the presentation. But yeah, thanks for coming. So we're just going to have a look at a few different, well, a kind of out there basic income proposal where we replace the current system in the United States as it is with, as I'm sure you all know, the tax and benefits that can be not exactly helpful to people that claim them or pay them, and replacing them and see what it's like if we had a universal basic income policy instead. So yeah, next slide, please. So just for an overview of what we'll have a look at, firstly, just going through the current system. So of course, tax and benefits exists, but there's a lot of particularities in each of them that creates obstacles or creates inconveniences for various different benefit claimants. And just having a look at what the current system is now before we look at what it might be in the blank slate. So this is a policy proposal where we say, okay, what if we essentially flatten the current system and added a UBI and yeah, saw how that could change and the impacts on the distribution of income and income inequality and things like that. So yeah, and then finally we'll have a look at those results. We'll look at who comes out ahead, who comes out behind, and other impacts like breaking it down by geography or by income decile and things like that. So yeah, next slide, please. Okay, so the current system is pretty complex. You've got, firstly, just the progressive tax system, and this might seem sort of inherently fair because we've got a federal income tax that rises. You pay a higher marginal tax rate depending on how much income you have. And then you also have taxes like payroll and self-employment tax, which can actually be sort of regressive because they have a threshold at which you stop paying them. And then you also have against progressive income taxes, you have tax credits. So these are a mix of refundable or non-refundable credits. Non-refundable credits being credits that are capped at your income tax liability. So if you don't have any earnings to pay income tax with, then you're kind of cut off from most of these credits. But you have some refundable credits as well, like part of the CTC. So tax credits have some particular work incentives and disincentive effects because of how they phase in or phase out with income, which ends up creating quite a complex system. And of course, the non-refundable credits, or the ones that phase in particularly slowly, often fail to reach non-filers at all, because if you don't file your taxes, then you don't get a tax refund. And that's just another step people have to climb to get to these support measures. And then finally, outside of the tax system, you've also got a whole slate of means-tested benefits. So you've got things like food stamps or SSI, and all of these tend to have really high phase-out rates that stack. So if you're claiming multiple means-tested benefits, you'll have different benefits withdrawn at the same time, and that creates really, really high tax rates, much higher than what you'll be paying at federal income tax at that level. And then you've also got, even worse than just marginal tax rates, you've got welfare cliffs, which are effectively infinite marginal tax rates, because a lot of these benefits have a eligibility cutoff, where if you go over it, then you suddenly lose a lot of money. And that creates a pretty big problem for people who want to actually financial plan and optimize their current situation. And of course, these also fail to reach non-claimants, because if you don't apply for the benefits, you don't get them. And so you need to have filled out the paper form and things like that. Next slide, please. So yeah, we can have a look at some of these credits. So the chart on the left is the earned income tax credit for single filers, with the different lines for the number of children that you might have. So on the x-axis, you've got employment income. So the more you earn, you start to rise in your EITC entitlement, and then it caps out, and then it starts to fall again. So you've got a phase in, and then you've got a peak, and then you've got a phase out. And this might make sense because the people who designed it were probably thinking about work incentives and how do we make sure that it phases in so that you're rewarded for earning more. But that also has the opposite effect of just excluding the people that probably need it most, like people with zero earnings who won't get any just because they don't have any earnings. So that is a bit of a double-edged sword there. You've also got, on the right-hand side, SNAP allotments by income and number of children. So SNAP being food stamps, of course, you start with the maximum amount, so it doesn't have the same problem as the EITC. You start with the maximum amount, and then it's tapered away. So anyone with no earnings or some earnings at least gets some SNAP. But then you start to have a pretty high marginal tax rate when this starts tapering down to zero. And actually, as you can see on the end, it also ends in a bit of a cliff because it's got multiple income definitions, and you'll go off one of them faster than you will the other one. So you'll reach a point where if you get like a $1,000 pay rise, you could actually be worse off because of that. And that seems like a problem. So the current system is defined in this sort of very particular language where you've got different phase-ins and phase-outs and cliffs. And those were all designed for particular reasons, but they have really massive problems. So next slide, please. Yeah, so the question is, what if we did not use that language that the current system is defined by? And what if we said, okay, let's just level the current tax and benefit system and replace it with what a universal system might look like? So we're going to replace the federal income and payroll taxes, just completely get rid of them and replace them with a 50% flat tax, which is pretty high. So this is pretty far from political feasibility. But then we're also going to abolish most means-tested benefits. So SNAP goes, SSI goes, WIC and TANF, and then also housing subsidies. So of course, we need to make sure that the UBI payments at least compensate people for that, and you don't have just massive damage from abolishing a lot of benefits, which would happen without the UBI payments. So that's where the UBI comes in. So instead of just claiming those benefits, you'll get an unconditional cash payment depending on your age. And these amounts are ranging from $550 a month if you're between 0 and 5, up to a pretty generous adult UBI. So that's in excess of $1,200 every month for working age adults over 25. And these were decided in a very particular way. They're kind of precise for a reason. Next slide, please. So these are decided based on optimization, because I think a lot of the time we design UBI policies based on maybe poverty lines or some other measure of needs, because we think of UBI as getting to people to their basic needs. And that's still the goal. We still want to match people's basic needs when we have a UBI policy. But aiming directly at there is often, I think, not the most effective way of actually meeting that goal. Instead, what we can do is we can specify the outcome that we want, and then let machine learning optimization do the heavy work of figuring out what actual parameters of the UBI policy you might need to get you there. So for us, what we do exactly is we say we want to minimize the mean percentage loss. So the mean percentage loss is defined as the average percentage loss, or 0 if you're better off. So if you lose 10% of your income, your percentage loss is 10%. But if you gain 10%, then your percentage loss is 0%. And so this is just a mathematical definition, but it's essentially just a proxy for really bad disruption, as in it will weight losses among low-income people much more importantly than it will if a really high-income person loses $1 of income. So essentially, we're just saying to an optimizer, decide these UBI payments for me, and don't shake anything up if you don't have to. But equally, if you have to take $1 from a high-income person and give it to a low-income person, that's going to be a net gain under this sort of loss function. So yeah, next slide, please. So we can run this through a microsimulation. We're using the PolicyEngine app, which runs off a static microsimulation model. So essentially just recalculating taxes and benefits in the baseline and the current system and looking to see what changes, whose net income rises and whose falls. So next slide, please. Yeah, so the core takeaway of it is that it's really, really progressive. So even if you get rid of most means-tested benefits and have a massively flat income tax rate that's pretty high, the power of the cash transfers is just so high that it pretty much dominates all the other effects. So you've got the wealth or the income of the bottom decile rising by over 80%, which is quite substantial. And then you've got all income deciles below the 7th decile actually seeing some net increase in their income. Next slide, please. But of course, what that chart doesn't tell us is within those income deciles, how many people are coming out ahead and how many people are coming out behind. Because you might have a chart like that then is just a few people coming out pretty far ahead, dominating some losers within that decile. But we can plot that as well. So if you look at this chart, this is showing the 10 income deciles, and then within each one, we're showing what percentage of people come out a lot, so gaining more than 5% of their income, and then what percentage of people come out behind or come out slightly ahead or behind. And we can see that pretty much everyone in the bottom deciles does come out ahead. So over 90% of deciles 1 through 4 all gain more than 5% of their income. And this likelihood of coming out ahead decreases pretty rapidly the richer you get after that. You have, of course, got some people coming out behind in the current system. And that, in terms of UBI proposals that shake up the existing system or are big enough to shake up the existing system, it's almost impossible to get that to 0. So I think there's definitely a case for seeing how much further you could get in terms of reducing those low-income losses. But the gains to the 90% of those income deciles is outweighing the 2 or 3% in each one in that graph. But yeah, so next slide, please. So yeah, if you break this down by geography, then you start to see a pretty expected effect. Poorer states gain lots of income, and richer states tend to lose them. So you've got things like West Virginia, Mississippi, and New Mexico, and then of course you've got the richer states. And this tends to range between just over 10% and minus 10%, and that's sort of the size of the transfer that we're looking at between these states. Next slide, please. But yeah, so the other question though is, even within that bottom set of income deciles, who are these people that are coming out ahead and behind? Because you might expect that maybe it's just the people already on the means tested benefits that are getting removed, that are coming out behind. But actually, most people, the vast majority of people claiming each of those benefits does still come out ahead. So this chart is kind of like the decile chart that we showed previously. We're basically showing for each type of benefit, what percentage of people come out ahead or behind. So housing subsidies, 90% of people on housing subsidies come out ahead. WIC has a really, really high percentage of people who benefit, and the same for TANF and SNAP. And then SSI is a bit lower, mainly because the retired population has Social Security, which is taxable by the flat tax. But yeah, but most of these, I mean, the vast majority of people on these means benefits do come out ahead. And at the same time, we're cutting poverty a lot and being pretty progressive in that sense. Next slide, please. Yeah, so speaking of poverty, poverty falls by a really, really high amount with this UBI reform. So if we split the population into children, working age, and seniors, then you see child and working age poverty down by 3/4 to 80%, which is just sort of unprecedented. Senior poverty falls, but not by as much, mainly because of the taxability of Social Security. But of course, overall poverty down 70%. So that's a pretty big effect. But yeah, so next slide, please. And then, of course, the flip side of this is that inequality is also falling by a lot. So we can measure inequality in a few different ways. The most common of those is the Ginny Index, and that falls by just under 1/4. So the Ginny Index of income inequality, essentially measuring how equally income is shared, and we're talking about disposable income here after tax and benefits. But then if you also look at like the taxing the rich kind of metrics, so the top 10% share of income, so the percentage of all net income that is held by the top 10% of households is going to fall by just under 20%. And the same sort of effect for the top 1%. So even though it's flat tax and they might be paying close to that rate anyway, just because of how broad the tax rate is, they are going to see a pretty significant fall in their share of total income. Next slide, please. So yeah, and then if we look at how individual households, I mean, taking a step away from the population impact, we can break this down and look at just a single household. So this is a household with 1 adult and 2 children. And you can see in the baseline, their net income is lower than what it would be in the reform for a pretty large section of their income. So until they reach about 90K of market income, then they are better off. And this is mainly due to just having people in a household. So the nice thing about the UBI policy is its simplicity, because to be better off, the single most effective determinant of that is that you have children or adults in your house, because then the UBI payments just dominate whatever you're paying in excess taxes. You still have some cliffs though. So we haven't abolished school meal subsidies in this, and that has a slight cliff because there's an eligibility cutoff for that. So that will remain in the current system, but you don't have any of like the massive SNAP cliffs or things like that. Next slide, please. Yeah, and so the other aspect of this is work incentives. So on this chart, we're basically looking, and I hope you can all see the gray in there, but we're basically looking at what is your marginal tax rate at each point of earnings. So it starts off in the baseline pretty negative because you have the EITC phasing in, all of those tools that we use to sort of exclude people from, if they have too low earnings, from getting the EITC. The effect that creates is that you have a negative marginal tax rate, so the state rewards you for every dollar you earn. But then that gets pretty high pretty quickly, because if you have a phase in, you have to also have a phase out. And that can mean that the marginal tax rate for a household can be between 40 and 80%. And it's pretty unpredictably in that range as well. You've got even weird slanted lines from things like the ACA subsidies. So trying to guess your marginal tax rate in the current system is just kind of impossible. But in the reform, things are a lot clearer. So it's still a bit of a bumpy line because we haven't got rid of state tax, and we're showing that here. But you can expect a pretty clear marginal tax rate in between 40 and 55%. So that makes it a lot easier to know, okay, if I'm going to get a pay rise, am I going to be better off or worse off? The answer to that question is just always yes in the current system. in the reform system. But yeah, so, yeah.
Oh, just like another minute.
Oh, okay. Yeah, so next slide, please. So after all that, the main conclusions of this is that the current system is just really, really complex. And if you want to get rid of all of the things that make it really complex, like tax and benefits, then you can do that. And you can also optimize parameters of basic income so that you don't unnecessarily shake things up too much. And then the other things are, if you want to have large UBI payments, I mean, in this one, we've made a budget neutral reform, and you need a pretty large tax base to make that budget neutral. And that is kind of inevitable for this level of UBI that's this big. And the end of it is that we can abolish current benefits in a safe way with UBI, which will create probably a much fairer system for this kind of thing. Yeah, I think that's it.
Thank you, Nikhil.
Thank you.
Next up, we're going to have Almaz Zelleke come in through virtually from New York. Almaz, y'all set? Can you hear us all okay? We can't hear you yet.
Can you hear me now?
There we go. We got you.
Okay, so I'm ready to go. I just I'm not getting the little icon to share my screen. So if somebody on the tech side can tell me what to do to share my screen.
Can we help her share her screen?
Oh, wait. Okay, I think I got it.
All right, here we go.
Everybody
We
can see
see it.
that? Great.
Yep.
All right. So I think this is a nice paper to follow Nikhil's paper because it takes a slightly different approach to the same issue. And I'm just going to give everybody the link to the paper and the link to the slide deck, especially for people who are following at home and might want to look at the slide deck on their own rather than on the small screen of their of the viewing window here. So that's that. Okay, so I always like to start out any presentation on basic income by saying what my goals are, because not everybody shares the same goals. So my goal for basic income and what I'm thinking about when I'm thinking about how it should be designed and implemented is that it should eliminate poverty or get as close as possible to eliminating poverty, should increase economic security because our poverty rate in the United States is really inadequate. And so I want to actually go beyond that and increase economic security for even people who are not technically in poverty. And I want to reduce inequality, including income and wealth inequality and also gender inequality. So my premise is that that requires redistributive and progressive taxation of income or wealth or both. I'm not going to defend that, but we can talk about it in the Q&A if anyone wants to. Okay, so in this paper, what I am looking at is how an individual basic income interacts with joint taxation of married couples. Because joint taxation of married couples is the system that we have in the US. So, for example, in Nikhil's presentation, I'm assuming that the effects that he's showing on taxpayers is on tax units, which is single taxpayers, married couples who don't really have the option of filing separately, and heads of households. Those are our basic tax units in the US. So what is joint taxation of married couples? It means that couples pool their income in calculating their taxes. What that means is that tax brackets are increased for married couples over single taxpayers. If they were the same as single taxpayers' tax brackets, then we would have individual taxation of married couples. But in fact, in the US, we have joint taxation. So the tax brackets are larger up to being doubled. Obviously, this is a kind of a simplified view of the tax system. As Nikhil mentioned, there are many credits and exemptions, et cetera, that complicate the effects of just the tax brackets and the tax rates themselves, but this still holds largely true. So what this joint taxation of married couples does is it creates what are called marriage bonuses, marriage penalties. So these refer to either reductions in the taxes that a married couple pays with respect to a single taxpayer, or increases in the tax they pay, and disincentives that vary with income level and the income split between couples, which has the effect of benefiting the most traditional married couples. And by traditional married couples, what I mean are couples in which there is one earner, one person who engages in paid labor, and one person who engages in unpaid care. That's what I'm calling a single earner couple. There's also unequal earner couples where both spouses may work, but one makes significantly more than the other. For couples who have exactly equal income, there's no difference between individual and joint taxation of married couples. So here in the US, we are in the minority of countries with advanced economies. Most countries in Europe, for example, have switched to individual taxation, and for good reason, as we'll get into in a moment. So in this paper, I make 3 claims about joint taxation of married couples. Number 1 is that it's in tension with the individual distribution of a basic income. Second is that it creates second earner disincentives that discourage the paid employment of lower earning spouses, which has the effect of reinforcing gendered divisions of paid and unpaid labor. And third is that joint taxation of married couples creates marriage disincentives for low-earning couples. I'm going to focus in the slide presentation on the first and second, because I think the third one follows naturally from both of those. And just in the interest of time, I want to focus on the first 2. Okay, so just as a little bit of background, the literature on taxation of couples identifies this problem as the marriage tax trilemma. Right, so this is premised on having progressive taxation. If we just have a flat tax, as in Nikhil's presentation, this doesn't matter. This doesn't have this effect. Joint taxation doesn't have this effect. But assuming that we have progressive taxation, which includes not only the rate scale that we have now, which I'll show in a moment, but also any system that has a flat tax that also has an exemption level. Right, so the exemption level is effectively a 0% tax bracket. And so if in Nikhil's example, the blank slate example, if there is an exemption amount for the first, say, $10,000 of income, that's a 0% tax rate, and then the 50% tax rate would be on top of that. So it's not a true flat tax. That's a progressive tax system with 2 brackets. If we're talking about a true flat tax, then it's the first dollar of income gets taxed at one rate, and there's no change. So under progressive taxation, we have to choose, right? This is the trilemma. We have to choose between what's termed marriage neutrality or couples neutrality. So marriage neutrality means that single taxpayers and married couples with the same total income would say that pay the same in taxes, whereas couples neutrality would mean that married couples with the same total income would pay the same in taxes, but it's not necessarily the same as a single taxpayer would pay with the same income. So under marriage neutrality, progressive tax brackets are applied per earner rather than per person under couples neutrality. And single taxpayers and single earner married couples pay higher taxes than equal earner married couples with the same total income under marriage neutrality. Single taxpayers pay higher taxes than equal earner or single earner married couples under couples neutrality. So marriage neutrality, if we're prioritizing that, then we individualize taxation. If we're prioritizing couples neutrality, then we're in joint taxation of married couples. So this is the rate schedule that is currently the law in the United States. It was changed in 2017, and you'll see if you look at the 10% tax rate bracket for single taxpayers, it's $0 to roughly $10,000 in income, and for married couples filing jointly, it's doubled. Right, so this doubling of the tax brackets for married couples versus single couples extends until the last 2 tax brackets at incomes let's say approximately above $400,000. So for most taxpayers, the tax brackets for married couples are doubled as compared to the tax brackets for single taxpayers. Okay, so what effect does this actually have? Let's talk about first the tension of joint taxation of married couples with an individual basic income, and then I'll get to the second earner disadvantage. So if a basic income is funded with progressive income, and this applies also to wealth taxes as well, for married couples with incomes in the phase-out range, the net benefit or cost of the basic income varies for couples with the same total income but different income splits if we're in a system of individual taxation or in a system of joint taxation. So that means also that the inter-household benefit or burden of the basic income and the tax shifts between these two systems of taxation. And also importantly for gender equality, the intra-household tax burden within married couples shifts between spouses, depending on which system we use. So to illustrate this, this is my model basic income. Let's say it's a basic income of $6,000 per person financed by a 3% tax on incomes above $100,000. So it's very simplified. There's no phasing in or phasing out of that tax. It's just to show the differences between individual and joint taxation and what the effect would be. So the actual numbers I'm going to show in the next slide just depend on this particular model, but the direction of the effects would be the same regardless of how one what the actual numbers were in terms of the tax and how it phased in or out. So again, as in the US tax system slide that I showed earlier, the brackets under joint taxation are just doubled. So if the tax surcharge starts at $100,000 for a single taxpayer, it starts at $200,000 for married couples. Okay, so this is a kind of complicated table to present in the conference, but here's the important takeaways or how to look at it. So I've color-coded the first columns with blue and pink to reflect the gendered nature of our income system today. All right, so in married couples, the primary earner tends to be male. And to earn more than the secondary earner who tends to be female. But obviously this applies to same-sex couples as well if there's any income difference. So what the first white column is showing is the net basic income that would result from a system of individual taxation with the tax structure that I indicated. So if you're below the phase-out range, both the spouse 1 and spouse 2 get their full basic income of $6,000, and there's no tax on it, so they net $12,000 as a couple. Doesn't matter what the income split is between them. But if we look at couples that are in or outside of the phase-out range, so let's look at the next row, which is a single earner married couple where the primary earner earns $100,000 and the secondary earner earns $0. The primary earner is in the phase-out range. So they get a $6,000 basic income, but they pay $3,000 in tax, so they get a net basic income of $3,000. Whereas the secondary earner is not earning any income, so they get the full benefit of the basic income. They don't pay any tax, and the couple together nets $9,000. Now, if we switch to a system of joint taxation, which is in the purple columns to the right, then because of income pooling, the total income for the married couple is below the phase-out rate of $200,000 for a married couple. And so they both keep the benefit of their basic income and they net $12,000, right? So you can see right here that under individual taxation, this couple, the same couple, would net $9,000. Under joint taxation, this couple nets $12,000, and it's completely because the primary earner who should be in the phase-out range of the basic income is able to appropriate, in a sense, the part of the the below phase-out range income of their spouse. So this might seem like, well, it's a good, it's great. Why not just give this married couple this bonus of $3,000? Well, in a tax system, this bonus is coming from someplace, and so the question is, who's subsidizing it? And it's likely that's going to be single taxpayers, because a single taxpayer earning $100,000 is only going to get a net benefit of $3,000. So I won't go through all of these rows here, but just to show that once you get a little bit higher in the income ladder, then the effect switches, and you end up with some bonuses under individual taxation and some penalties under joint taxation. So again, the numbers themselves are not as important as just showing that if you have what seems like a gender neutral and single and married couples neutral basic income structure, it actually has different effects depending on whether we are taxing married couples individually or jointly. Okay, moving on to the secondary earner disincentive. Under progressive systems of income taxation, again, it's only under progressive systems. The system of joint taxation of married couples primarily serves to lower the taxes of single earners and primary earners in unequal earner married couples. The inter-household tax burden shifts, as we just saw, from high-earning primary earners and married couples to single taxpayers under joint taxation of married couples, and the intra-household tax burden within married couples also shifts. It shifts from primary earners to secondary earners under joint taxation of married couples, and this creates a secondary earner disincentive, reinforcing gendered divisions of paid and unpaid labor. So here in this chart, this is a tax system with 4 brackets, 0, 10, 20, and 30% tax rates, just increasing with every $10,000 for single taxpayers, and with doubled brackets for married taxpayers. Again, the numbers are just illustrative, but the direction of the effect is true under any system of progressive income taxation with joint or individual taxation. So again, with a single earner married couple with an income, let's say, of $10,000, the tax due under this model is $500 under individual taxation of married couples, and it's 0 under joint taxation of married couples. And this effect, you can see the numbers that are bolded are the higher tax burdens that are due under individual taxation, and the italicized numbers are the numbers that are the lower amounts of tax due under joint taxation of married couples. But for gender equality, there's an important intra-household effect as well. So here I've broken down the income by spouse as well as the tax due by spouse. So spouse A is the primary earner, spouse B is the secondary earner. And what you can see is if we move to the unequal earner married couple, the 2 columns to the right, you'll see that under individual taxation, where the total family income is $10,000, but $8,000 is earned by the primary earner, and $2,000 is earned by the secondary earner. Under individual taxation, the couple will owe $300 in tax, and under joint taxation, they'll owe 0. Okay, so far, no, that's the inter-household issue, but it's not the intra-household issue. The intra-household issue increases with increased income. So this is a problem that's a bigger problem for higher earners rather than lower earners. And again, this tax model is a very simplified one, so it's not taking into account any tax credits like the EITC, right? So it's just trying to isolate this issue for the intra-household distribution of income taxes. Also doesn't have payroll taxes, which I'll get to in a moment. So you can see that for what I'm calling the middle class family, under a $16,000 or $20,000 total income, but with an income split, an uneven income split, the primary earners' taxes go significantly down. Oops, I'm sorry. Are significantly lower under joint taxation than they are under individual taxation, but the burden on the secondary earner increases from 0. Under individual taxation, their income of $4,000 would not qualify for taxes, they're still in the 0 rate. But because under joint taxation of couples, the income of the secondary earner is effectively stacked on top of the income of the primary earner. And so they're taxed at the marginal rate, the highest marginal rate of the primary earner. So their tax increases under joint taxation of married couples to 400 as opposed to 0, and so on as we go up higher tax brackets. So the issue here is that the system of joint taxation of married couples not only shifts the tax burden between single taxpayers and married couples, but also within married couples between the spouses. This is most likely to have an effect for spouses in which one spouse is not working, perhaps after taking time away from employment to care for young children, and then is thinking about going back into the workforce. And then if they sit down and do their calculations about how much net income they will bring home from that secondary earner's income, that's when the problem that joint taxation of married couple shows, right? That they're actually going to be bringing home less income than the primary earner at that same level of income, because they're now at a higher marginal tax rate than the primary earner was. Payroll taxes, of course, are taxed on the first dollar of income, and so they're not progressive in that sense. So that's an additional tax burden that the secondary earner is going to face. And of course, if we're talking about a family with children, we're talking about childcare costs and potentially other fixed costs of work, like in many parts of the United States, a second car might be necessary for a secondary worker to go to work. So this is where we get into the situation that we see ourselves in now, which is when there are any issues around the cost of childcare or the other fixed costs of work. It often seems to make sense for the secondary earner to stay home and continue providing that free unpaid care, and for the primary earner to actually take on more, either take on more hours or try to achieve a promotion to get more money, right? But that there's more investment in the primary earner's labor force participation than in the secondary earner's labor force participation. So that's, if we're looking at this kind of the theoretical effect that we would expect from the tax rates, that's what we would expect. And then what I'm turning to now is the actual empirical data that supports that this actually happens in real life. So this is data from 2 economists, Alexander Bick and Nicola Volk-Schulden, who have done a lot of work recently on these questions. So here, this table is showing that this is data from 18 countries, 18 European countries and the United States, averaging out across all those countries what the mean hours in paid labor are for married and single men and women. So the average shows that married men tend to work the most, single men follow, single women follow, and then married women tend to work the least. But the interesting thing to here is that the correlation between married and men's and women's hours is not very strong, right? So these correlation numbers at the bottom are higher for the single men and single women, and very, very low for married women. So that's a puzzle, right? Because in general tax theory, we expect that countries with high average tax rates, so for example, Scandinavian countries with close to 50% tax rates, tend to lower the labor supply of everybody. But those tax rates, in theory at least, should apply equally to men and women, married men and women. And so you would expect to see more of a linear decline, even if there are other reasons why married women might not participate as much in paid labor. But in fact, we don't see that. We see lots of variation. And so they set out to explain that. And so what they found is that, in fact, it's the system of taxation that has the largest effect on married women's paid labor supply. So this chart is showing, this diagram is showing that across the 45-degree line, that's the comparison between the average tax rate that a single woman would face and the average marginal tax rate that married women face. So any countries that fall right along that diagonal line are countries that have individual taxation: Greece, Hungary, the United Kingdom, and Sweden. Countries with that are above that 45-degree line have some form of joint taxation, and the countries with the largest gap between the average rate that a single woman would face and the marginal rate that a married woman would face are Germany and Belgium. The United States here is somewhere in the middle, but this is because this data precedes the 2017 tax change, which doubled the tax rates for married couples. Prior to that, they were between 1 and 2, about 1.5 times the size of a single tax bracket for single taxpayers, but now they've been doubled. So Bick and Fuchs-Schundel went on to model. They've got a lot of data on average hours worked and on these tax systems across all these countries. So what they modeled in the first panel of this diagram is a shift from joint taxation to individual taxation. So what you can see is there's no change in labor supply for the last 4 countries, Greece, Hungary, Sweden, and the UK, because they already have individual taxation. But in the countries with joint taxation, the changes in paid labor supply that their model predicts are quite significant. So the darker bar is the labor supply of women. So you see in the countries with the largest gaps in the previous diagram, Belgium and Germany, the hours of labor supplied by women is in the magnitude of around 300 hours a year. And if we go back to the slide that showed what their average hours were, you can see it's about 30% of what their average hours were. It'd be a 30% increase in their hours worked compared to the system of joint taxation. Interestingly, also, what this fainter bar is showing is that the average hours of men would decrease under the system. And just in relation to the previous presentation, I want to show also the second thing that they did was they took this model and then they added, they switched from a progressive tax system to a linear tax system, holding revenue flat. And what this shows is that if you decrease the progressivity of the tax system, you actually end up increasing men's hours worked and much more than women's hours worked. And in fact, the effects change. They're not as clear as they are. So what this shows is that if we actually want to increase women's paid labor supply, we want to move from joint to individual taxation. If we want to increase men's labor supply, we want to reduce progressivity in the tax system. So before I move on, let me just say that this may seem like an odd thing to be advocating for, or to seem to be advocating for in a basic income conference. And I want to say that, in fact, I'm not actually in favor of people working more. One of the reasons I support a basic income is so that people can decide the mix of paid and unpaid labor and leisure that they want for themselves and their families. But what we do with a joint system of taxation is we actually reinforce existing gendered divisions of labor. And if we want those divisions of labor between paid and unpaid labor to be more gender equal, as many basic income advocates do, and many feminists in particular do, then we want to switch to a system of individual taxation. So the third claim that the paper makes, I'm not going to go into here, is that there's also a marriage disincentive effect for low-income couples, and that is because income is, again, pooled at the low-income level with respect to benefits as well as with respect to taxes. And that means that low-income people kind of speed through the phase-in rates of a program like the Earned Income Tax Credit and speed out through the phase-out rates with those steep tax rates that Nikhil mentioned. And in fact, for low-income couples, most of the benefits pool income across households, not only across married couples, so that even poor people who are not married who want to live together to take advantage of household economies of scale have to report that income against the eligibility requirements for tax for benefits that are means tested. So for all these reasons, we want to move to a system of individual taxation in the United States, make it easier to implement a basic income, and will make it easier to move beyond the gendered divisions of labor, paid and unpaid labor that we have now. All right, and that's it. Thank you.
Aleida will be up next.
Right, I'm going to go ahead and stand just so really weird sitting and talking. And also, I can't see my own stuff. So I'm just going to wait for the slides to roll up.
Can we get Aleida's slides up?
No. Well, while we're waiting for slides, I can introduce myself. My name is Aleida Baumgartner. I'm an MA student in Econ at NYU right now. I'm finishing up my master's degree there. I wrote this literature review for a course that I took in income distribution in the United States for an MA class that I took in the fall. So this review is focused specifically on all the econ literature that I could stuff into 30 pages. Of course, there's a lot more that I could not address. So, of course, there's about how a potential UBI could impact income inequality in the United States specifically. Obviously, I'm not going to be able to address wealth inequality or other types of like consumption inequality. There's all kinds of inequality that exist. There's not just income inequality, but I will do my best. Let me see if there's nothing to flag before I start. No, and it looks like it's still reading on the slides. Do you need me to send those again? Okay. Well, I can continue to address the main approach that I took. So, as an econ student, I had to focus on the econ literature out there, and there's kind of two streams of literature that I found that talk about how a UBI could affect a income inequality in the U.S. And there's kind of like a theoretical literature out there, and then there's the experimental literature. So theoretical literature addresses how we have, there's like theoretical literature about taxes and about how we can set up a specific tax structure to potentially create a UBI, and then compare that to what our current welfare system already has, which is a progressive system. And then there's also a bunch of like micro simulation models. So this is kind of like the new thing in econ now. It's not that new, but it's becoming an element. It happened. Woohoo! All right. You can go ahead and skip the next one. I already kind of addressed this. All right. Oh, that's unfortunate. Some of the formatting's on my side, but we'll go on. All right. So as I was saying, if you could go ahead to the next slide after this. All right. We'll just have to deal with that formatting, but it's unfortunate how it is. But as I was saying, there's theoretical literature, and then there's also experimental literature. So the experimental literature is kind of the term that I apply to papers that looked at, rather than how a potential national level UBI would affect income inequality, they address what results we actually have from existing pilots. Of course, there's a lot of UBI pilots in the world. I think there's at least like 90 now. That was addressed in the original presentation yesterday, the very first one. So I can't address all of those. I just picked a couple that I thought were relevant to understanding income inequality in the United States. So if you could go actually back to the previous slide. Cool. So before I start, just wanted to provide some definitions. When I'm talking about UBI for the purposes of this review, I'm referring to a classic UBI, which is it's national level. So I'm not really addressing any state level stuff, which is unfortunate, but that's kind of just what I had to do for this. It's basically a lump sum grant to all individuals. So we just take a bunch of revenue, divide it up by the number of people in the population, and then give that to everybody. The way I define a UBI, which is from Hoynes and Rothstein, which is like a really good review of UBI in the United States from 2019, is that it has to be unconditional, so there's no means testing when you give it out. It has to be universal, which means everybody gets it. And then it also has to be basic, so it needs to cover every person's basic needs. So like food, housing, you can debate whether or not that includes healthcare or not, but food and housing for sure. So according to this definition, there is no true classic UBI pilot that's ever been done because we don't have a national level UBI that would require actually instituting it. So the best thing that we can do is to A, model it, which is what the theoretical literature is about, and B, we can set up pilots in states and cities and see what happens. We can't replicate what that would mean at the national level in real life yet, because that would mean actually doing the whole thing, which, you know, we all hope that will happen, but it's not yet. So that's different from a negative income tax. And this was kind of the original idea that Friedman, who was like a famous economist, he proposed this in 1962, where he said, rather than have, you know, where you send out all of your taxes to the government every year and you pay them, you owe, if you're underneath a certain income threshold, you get money back. And this is kind of what the earned income tax credit is, the idea that it's based on. But NITs and UBIs are very closely related because you can kind of think of a UBI as an NIT with no baseline. So we can use NITs and model those as kind of what I call UBI adjacent policies, because that's what we end up testing in the field in pilots, is something that's UBI adjacent and not the full, like, let's do the whole thing right now type of thing. And then of course there's the earned income tax credit, which is essentially a wage subsidy. If you earn, you get a subsidy on your earnings. And this was kind of done so that people were worried about individuals like leaving the labor force and us cutting labor supply when we instituted, or when we could have potentially instituted an NIT. So that kind of led to the EITC. Next slide. Okay, I think I addressed this already. Next one. All right, so I'll start with the theoretical literature. And I think I also talked a little bit about this, but I'll just go into more detail. So when we start with the tax model approach, and these are just like purely theoretical papers, right? They're not really focused too much on what the actual welfare system is quite yet. They're not at that level of complexity. We start with modeling a very basic flat tax plus a lump sum redistribution. So a flat tax, for anybody who isn't aware, because I know not everybody might not know what that is, it's when you take the same percentage of income from everybody as tax. So right now we don't have a flat tax system. We have a system where if you're in different brackets, you give a different percentage of your income in taxes. But the most basic way to model a UBI is flat tax. Everybody gives, let's say, maybe 10%. Of course, not real, but just for argument's sake. And then you give all that money out by the exact amount of people that are in the population. That's the lump sum redistribution. So the way that this literature approaches UBIs, it says, let's start there, because that's the simplest case. And then let's add in complexities, make that system more progressive by adding like 2 tiers, 3 tiers of income, and see if we can improve measures of inequality based off of comparing those results. And the main measure of inequality that we're talking about is the Ginny Index, which is basically, I don't want to go into the whole calculation of it because that's really boring, but the Ginny Index, for those who don't know, is a measure of inequality, and it measures inequality in frequency distributions, which is used for income distributions a lot. And when the Ginny Index is 0, that's when you have really low inequality. So everybody is the same. And higher it is means that there's a lot of inequality. So if the Ginny Index is 1, which is its maximum value, then basically one person has everything and everybody else is completely destitute. So what we're looking for with these is to see which approach can lower the Ginny Index the most. And there are other measures of inequality, but that's the main one. So then we have microsimulation approaches, which say, okay, let's take a computerized model of the economy with a bunch of little heterogeneous agents, and then see what the big results are on huge macro indicators. So things like GDP and also the Ginny Index. Next slide. All right, so the first theoretical paper is by Merrill, Groffman, and Barnes, where they essentially do exactly what I was just saying. They start with, like, let's take a very imaginary income distribution. They make this up. This is not based on data, but it's helpful just for the thought process of what would happen if we did a classic UBI in the US. And they say, all right, let's do the flat tax lump sum, see what happens, make it more tiered, add 2 tiers, add 3 tiers, and see the results. So basically what they say is that when you have a classic UBI, you can actually, with just a flat tax and lump sum redistribution, you can cut down the Ginny Index, but it's basically proportional. So whatever tax you start out with, you'll end up with like 1 minus T times would be the reduction in the Ginny Index. So technically you can reduce it, but you can improve those reductions in the Ginny Index by targeting the redistribution. So once they start with modeling a more progressive tax system, which is closer to what we currently have, then you end up finding that that is kind of better and gives you stronger Ginny Index reductions. Of course, the big caveat with this paper is while it's really helpful to see kind of the dynamics of how Ginny works mathematically, there's no data. They're just modeling this based on like a couple of different distributions, like exponential and gamma distributions. For those who know what that is, that's great. But if you don't, it's not that important. You can always read this on your own. But yeah, so that's their result. Next one. Okay, so Victor and Ludovic, I hope I'm saying that correctly in case they ever listen to this. Basically what they say, they're one of the first papers that I found that really did more of a micro simulation approach. So they took a bunch of data from, I don't really remember what it was, what the data source, let me pull up my notes, but it's not too critical to mention. Yes, it was from the SIPP, Surveyed Income and Program Participation. And so they took a bunch of data from people's actual tax results from 2008. So it's a bit outdated now, but still relevant. And they're basically like, well, let's model firstly current welfare systems. So they take all the different welfare systems that currently exist, kind of similar to what, Nikhil, you were talking about earlier. You guys have a similar model to that. And then propose 2 different UBIs. One is a net neutral UBI, a revenue net neutral UBI. And then the other is Andrew Yang's proposed UBI from his 2020 presidential election campaign. And basically what they find, and the big thing you should be looking at here is the earnings Ginny number. Again, I'm not addressing wealth inequality, just earnings inequality. They find that you can see the means tested, which represents current welfare system, gives you a Ginny of about 0.6, which is closer towards we're not that equal, right? Because it's closer to 1. The net neutral UBI gives you a Ginny Index of 0.57. But also, if you look at that Y variable up there, in econ language, Y is often used to represent GDP, like net output. So that means that we'd have to have an increase of GDP by like 2.4%, which isn't that good. So it's really expensive. If you see Andrew Yang's UBI, you get an earnings Ginny increase of 0.64. So actually worsened income inequality. But I mean, it costs less money somehow compared to the net neutral one. So yeah, more kind of equivocal and mixed results here that kind of indicate it's unclear whether or not a UBI as it's modeled in their paper would actually improve income inequality. Of course, that doesn't account for other types of inequality, right? We see the wealth Ginny tells us inequality in wealth and not just your labor earnings. So actually the UBIs are pretty good at decreasing wealth inequality here, but I'm not gonna get too much into that. But again, kind of not super certain unequivocal results. Next slide. Okay, so Garfinkel, Huang, and Nadic, again, I really hope I'm saying their names right, are again doing a microsimulation. And they basically come up with 4 different UBIs. And you can kind of see how they're split up here. Some of them are focused on different aspects of the population, but they're also not exactly classic UBIs like the other ones have been modeling. They're kind of more what I've been hearing some people in this conference call like a basic income plus. So they start with targeting different aspects of the income distribution and kind of seeing what the results are. You can read more about that on your own. Of course, this was written in 2002. So 1995 March CPS, it's probably not going to work for us anymore, but if someone wanted to replicate this, we could see what would happen. Next slide. Okay. All right, so they basically compare the results. Oh, go back, sorry, the wrong one. Oopsies. All right, let me pull up my own results here. All right, so essentially what they find is that while all 4 what they call BIG, so basic income guarantee plans, reduce the aggregate poverty rate, but they don't have a super big effect on the vertical distribution of income. So poverty and inequality aren't necessarily one and the same. They go together, but reducing poverty is about reducing the absolute amounts of need and income thresholds, while inequality is about changing where people sit relative to each other. So what they find is that while poverty gets reduced, income inequality per se isn't necessarily reduced very much by any of these plans. In the current welfare system, they find that the bottom 20% of earners, before any kind of distributions happen, are able to move up by about 5% in the income distribution when they get our current system of welfare benefits. But under these big plans, BIG, the bottom 20% only end up moving up in the income distribution by about 1%. So depending on what you want to focus on, poverty or inequality, you can kind of see there's like not super equivocal results. It does help poverty, but if you're more worried about inequality, maybe this isn't the plan for you. Next slide. All right, so Hoynes and Rothstein, this is like one of the classics about UBI in the United States. What they do is they model a bunch of different UBI proposals and also existing pilots that were around at the time. Of course, not all pilots because there's a lot. Charles Murray, I think he's the old president of the American Enterprise Institute, but he came up with one proposal in 2016. There's a Stern proposal, and then there's a bunch of UBI pilots. So that's Switzerland, Stockton, Finland, Ontario, and a bunch of others. And they kind of put them all into one framework and they say, all right, let's like run the numbers and see which one does the best. So to do that, they divide households into 4 different demographic groups. And let me make sure I pull up what those groups are. So those groups would be the elderly and disabled, those with children, low earnings, and combinations of those as well. So what they find when they actually run all these numbers, they discover that a smaller proportion of UBI dollars would go to the bottom of the income distribution compared to a general welfare system, which we currently have, again, just due to lack of targeting. What that means for actual poverty outcomes is not necessarily addressed, but what they find is that a canonical UBI would send a larger proportion of welfare transfers to people who we might not necessarily want to focus on as much, people who are not elderly or disabled or who don't have children, which isn't necessarily bad, but it just means that they're not as good at reducing income inequality specifically. Next one. Okay, Brown and Interval kind of do the same thing we've seen so far, microsimulation, but to OECD countries. If you go to the next slide, you can see their breakout of, next slide. Oh, thank you. So here you can kind of see what countries they focus on: Finland, France, Italy, and the UK. These are just their consistent basic income amounts. That's the poverty line in each of those different countries that those are applied to. And if you go back to the previous slide, thanks.
We just have another minute later.
What? How much? 1 more minute. Okay. Then you can see that essentially the BI does reduce inequality, but their reductions are very small, and it kind of depends on what country you're in. So if you're in a country where you end up with already pretty high transfers to people who are on the bottom of the income distribution, then a BI isn't going to help you as much because you're already getting those pretty heavy benefits. So if you go to the next slide, and then after that as well. All right, I'm going to skip this for now. Go ahead. Okay. So the experimental literature, which I don't have that much time to address because I'm running out of time, is essentially addresses firstly the Alaska Permanent Fund, US and Canadian income maintenance experiments, and lotteries and labor supply. The literature under lotteries and labor supply addresses how individuals respond when they're given a huge shock of unearned income to see what would happen if we actually did UBI. Would people just like cut out of the labor force and we'd lose that tax revenue in order to fund the UBI so that it would fail eventually? Essentially, it finds that labor supplies are not that changing, and it kind of depends on who you're looking at. If you're looking at women, they might be more likely to leave the workforce. Younger people are more likely to make educational investments, but overall, labor supply is not that responsive to systems of unearned income. The US and Canadian income maintenance experiments started in the 60s and 70s. These were the first really big pilots that were like, let's see what happens if we actually give people basic income. And unfortunately, it didn't lead to basic income in the United States at the time, but they were precursors to the EITC. And these were really focused on figuring out what happens to labor supply when we give people shocks in income. Of course, they're also looking at other stuff like health, nutrition, education. Originally, when these were first analyzed, economists and statisticians, sociologists were very like, oh God, these really reduce labor supply. And they were kind of concerned about that. And there was also this result that divorce rates increased. So it ended up not really having a lot of political backing. But recent re-looking at the data, reanalyzing has found that the shocks to labor supply were not as severe as it was originally thought, like 40, 50 years ago. So those are now kind of being reanalyzed. The Alaska Permanent Fund has found that, in fact, yes, there are some responses to getting that shock of unearned income. So they do find evidence that if you are living in Alaska and you're a recipient of this fund, which I'm sure many of us know about, and I'm not going to address for lack of time, but there are increases in part-time work as opposed to full-time work. But again, that's not an unequivocal result, and different people find different things. And then there are other more national level income policies that have been instituted. Iran, there was an interesting event where they took their, at the national level, they give out bread subsidies and energy subsidies, and they replaced those with straight cash transfers. So rather than in-kind benefits, they started in-kind cash transfers, and they said, well, what happens to unemployment? Well, unemployment spiked. But also, at the same time, Iran is a very different labor market to the United States. And in general, their unemployment is a lot higher than it is in the US, probably like 28%. I don't remember the exact number. But essentially, again, I just wanted to include that because it's an example of something close to a national level basic income policy. But again, debatable on how applicable that would be in a United States context. And Finland I want to mention because they also started some pretty good experiments, but unfortunately, when I wrote this paper, the results were only available in Finnish and not in English, and I am no Finnish-speaking person, so I couldn't really look into those results as well as I would like to, but essentially what you find at the end of looking through most of these results is that it kind of depends on how you set up a basic income theoretically, what happens to income inequality, and then it also depends on what actually we measure as true responses to labor supply. So how do people actually respond to getting a shock of unearned income is very dependent on their personal circumstances and not necessarily going to be fully represented in current models as they currently exist. In order to address that more thoroughly, we need to start building models that do build in different labor supply elasticities so that we can see what's actually going to happen if people who are perhaps women or who have children, how they would respond to UBI rather than just like, let's make everybody have the same level of responsiveness. And we also really need to have more pilots, especially pilots that include an entire community rather than just a single city, because how people respond in a community is very different from how they respond as just a single person who is alone in their neighborhood receiving that income. And there we go. That's it for me. Thank you so much for listening.
So, I'd like to thank all of our presenters. Unfortunately, we don't have any time for Q&A. We're already over. If you have any questions, please approach them throughout the day, ask your questions. And just like to thank you all for attending this session. And the recording of this session will be available on Crowdcast later today. The links can be found on the conference website. Please join us for the morning plenary, The Great Reshuffling, Pandemic Impacts and the Revisioning of Work and Labor, in the main room here following this session after the break. If you're a speaker in the next session scheduled here, please come to the stage to get set up for the live stream. And yeah, thank you all.